What is up, guys? Welcome back to the show. I'm actually really excited about this episode because I feel like this has been a long time coming.
Probably too long.
Probably too long. You guys, I think...
well, who do we got?
We've got Gabe Wilcox and...
Jay Snodgrass.
Jay Snodgrass with ScaleView Partners. Formerly, I think you both were formerly of Mineralsoft, correct?
Yeah, both co-founders of
Both
Mineralsoft.
co-founders.
So, okay. Let's get some context to this conversation. So both co-founders of Mineralsoft. Mineralsoft, you guys sold to Enverus or Drillinginfo at the time. What was that, like 2018?
End of 2018. Yeah, it was.
Okay.
We barely sold to Drillinginfo, and then it became Enverus shortly thereafter.
Yeah.
Yeah.
I think you guys were like one of the first acquisitions whenever we started doing this in the kind of the podcast scene. Yeah, you said, what was it? Was it 2018?
Yeah, right before Christmas 18.
Yeah. So it was like one of the a memorable thing.
Man, y'all should have been one of our first shows. We fucked up there.
I know.
It was memorable to us. I don't know. You
Yeah.
guys would be forgiven for it not being as big a deal to you, but it was. Yeah,
No,
it
I
was
remember.
good.
Look, I had the date right and everything. I
That's it.
remember. So, no, because we had started the podcast October 2018. And so I remember specifically that y'all's acquisition and us starting the podcast kind of coincided in timing to some degree. So we're going to have a lot to talk about today, but let's start off with what is ScaleView? Give us the high level overview of what that is, and then we're going to rewind it back to Mineralsoft.
Perfect. So ScaleView Partners helps founders of tech companies sell their company or raise growth capital. So we're an investment bank. Investment bank means a lot of things.
Yeah.
And, typically a lot of services involved when you think about a big Wall Street bank. We do something really, really specific, which is just working with founder-led tech companies, companies who look like Mineralsoft, frankly, in energy and beyond. When they're looking to sell the business or bring in an investor to get, perhaps a little bit of founder liquidity, some growth capital to ramp the business. So we'll help advise on that process and get to a good outcome for founders.
So that's pretty interesting because you guys walk the walk and talk the talk. Y'all built a tech company, successfully sold it. I like to bash on investment bankers all the time, which we have a lot of investment bankers that listen to the show. So I love you guys.
But you guys are founders first.
Yeah.
We're a founder
founders
first investment bank. That's like its own category.
We think so. There's a little bit of that branding probably in the market. We don't think there's a whole lot of substance to it in the market in a lot of cases, and that's what I think we're bringing. So you don't see that many people who sort of start a company, go through the journey of growth, sell the company, and then come back and want to do banking. A lot of people may want to be VCs and do that sort of thing, but for us, we both started our careers on the finance side before we did the software company.
Yeah.
So we were sort of on that side of the fence. Worked with entrepreneurs all day, and eventually thought we got to do it. I mean, I personally looked up and thought, I haven't worked at a quote unquote real company in my whole career. I've been in an investment bank. I've been in a private equity firm. What do we build, right?
Yeah.
And so
I think you guys went down the right path because I think like. Well, you said usually the pipeline is you sell a company, and then if you want to get into finance, you become VC or
Angel investor,
rolling funds popping up. But we don't have to get into this. But I don't think VC's a great model.
No, let's get into it today.
I mean, 60% of VC firms don't return capital to LPs, right? And then if you look at it from the VC perspective, it's not like private equity where you're building up these massive funds that become profit centers that take 2 and 20. So even if you're fortunate, I mean, like some of the biggest climate tech funds are $700 million. That pales in comparison to private equity, right? And so I was always interested in the banking side because I'm like, oh, this is cool. You just do all the M&A, capital raises, things of that nature, and then you take a couple points or whatever that may be, and you can start to get to larger numbers that way. So
how did you guys think about that? I'm curious because like we said, like it is you see it all the time. Founders exit and then they just go and become VCs. Was it just something that you guys were familiar with coming from the banking side, or was it you just favored the model? Or
yeah, I mean, I'll go first and then let Jay weigh in. But I mean, for me, it's first of all, it's like an attempt at an honest evaluation of what I'm good at and what I'm not as good at. I think I'm an okay investor. I won't show you my trading accounts, but I'm an okay investor.
We need to pour up some whiskey. That way we can get him course. Let's pull up the trading accounts. I want to see this. How much money have you lost in crypto over the last few weeks?
I am I'm not on that one, for better or for worse. Not on that road. But I do think I'm pretty good. I'm a pretty good deal guy. I like deals. We were able to have a really good outcome with our company, and it was fun. And it's just, you got to try to do the work that you enjoy and that you're good at. And that's kind of my self-assessment. The second one would be, there's a lot of capital out there, right? And I mean, things are changing day to day, but even with the public market volatility, there's a ton of capital out there. And so no knock on all my friends who are raising funds. It's a very good business to be in, and it's if you're good at it, then it's an incredibly good business to be in. It's super high leverage, but there's a lot of capital, and I don't know if the world needed another fund to go chase the latest deal. But based on our experience at Mineralsoft selling it, and again, I did this at the beginning of my career. I sort of realized after running Mineralsoft, I didn't know shit about running a company when I was just doing the finance thing, and so I know a little bit more now. But having sold the thing myself, there's real value to a good advisor to help walk you through that and help you get to a good outcome. It is just for me and for Jay, and unless it's sort of your third or fourth exit, it's just a monumentally important transaction, to you financially and otherwise, right? It's your baby. You've sort of bled into this company for years. And so that sale is a really big deal on the financial side and on the personal side. And I just, I really appreciate the value of somebody who can, maximize your chance for a win, right? Yeah. Because you don't necessarily get that many at bats to do it right. So that's what drew me to this side of it.
I mean, I think the other cool thing about being on the M&A side in particular, so never mind being on the investing side versus advisory side, but even within advisory, being on M&A is awesome because if we do our job right, every time our clients, they're almost always first-time founders, and the nature of M&A is they're coming into immense wealth the first time in their life. They're $50-100 million that they had nothing. They have a rented apartment and they have college debt and bills, and all of a sudden now they've got significant tens of millions of dollars in their bank account, and we get to do that a dozen times plus, maybe 24 times a year when we're at peak. That's awesome.
Yeah.
And on the venture side or on the private equity side, outside of last year where it was wild with exits, but typically you have 2 or 3 exits a year of your entire portfolio, and it's taken years and years. That's a cool feeling too because you've been with them for a long time. But I mean, we get to vicariously relive our fun moments of when we sold the company.
Yeah, that's gratifying. Are you guys focused on certain sectors?
We're all technology focused. Our company was a vertical, other than being an oil and gas company, which it was a vertical SaaS company. And so when we've looked at whether it's oil and gas or management software for gyms and health clubs or something there's sort of a vertical SaaS playbook. Those companies tend to look alike and share some common themes. And so we're pretty focused on that. I would guess just, given the market dynamics of the last, 5 years or so, I guess 3 out of 4 deals that we end up doing will be SaaS companies of one kind or another. And the main thing we're really focused on is, we call it founder led. It doesn't have to be bootstrapped. To my point before, capital's been pretty easy to come by for a decade or more. But we're not mostly in the business of sort of talking to VCs to say, what do you need sold? How can we sort of help you cycle through the fund? That business is fine. But we're really out there going kind of bottoms up and just want to talk to founders about their business, whether there's a deal today or not. We think that's, in the back of people's minds at some point. So I'd say that's our main thread. All tech, probably a lot of SaaS, but we're pretty flexible. The really common thread is it's kind of a founder-led, business. And that's what Jay said. It's fun in that respect, where that's how we spend our time talking to people about that. It's a pretty fun way to spend your day, all things considered. And it's really fun on the outcome side.
Yeah,
it's a good thing to be a part of.
So I want to roll back the conversation a bit and talk about one. You said y'all both had backgrounds in finance before Mineralsoft. So I want to hear from both of you real quick. what y'all did before Mineralsoft, and then I want to talk about, this podcast is about ScaleView, but it's going to be a lot about Mineralsoft because we never had that podcast about Mineralsoft, right? And so I want to know y'all's backgrounds before Mineralsoft, how you guys started Mineralsoft, what led to discovering the problem, creating a solution. Like, let's tell that whole story right now. So first, tell me about what you guys were doing before Mineralsoft.
I'll start at, I was out of college, right out of college. I worked for a fund in New York. And we were talk about, being a former like deal junkie. We were, a team of 10 people, and we were doing on average 100 to 200 deals a year. So every day you're working on, a dozen deals at different stages. And it was mostly a growth capital for small really small public companies, and also some private companies. And it was sort of, 1 to 5 million type investments, sometimes highly structured. And we were doing a lot of stuff in capital intensive industries. So oil and gas was a big one. Mining was a big one. But also some tech stuff and what have you. And I did that I was there for about 10 years before coming to join with Gabe to do Mineralsoft. And we'll get into that, how that linked up. And I don't know. My background was working at the same fund, doing just deal junkie, doing deals. And that was cool.
Just popping out deals.
Yeah. It was great because, I sort of learned actually going in later to Mineralsoft where I ran sales. That's where I really cut my teeth and sort of learning sales. And my job was sourcing. And that meant that like, I was cold calling CEOs. I was my early 20s, calling guys in their 50s and, asking them if it made sense for us.
It very much is a sales process, right? I mean, you're having to build a relationship with these people, sell them on your firm. Why would they use you? And so, really is a sales process.
I'm not sure what's not sales. I haven't.
What isn't? What isn't sales in life? I mean, that's what I tell everyone. Soft skills makes the money. I tell a lot of engineers that because everything in life is sales. So. Yeah, agree with that 100%. So what was your background in finance?
Yeah, I grew up in Arkansas in a little town north of Little Rock. That'll be important to the story. I'm not just plugging Arkansas, but go Hawks.
Hey, Arkansas doesn't get a ton of plugs on the show, so give them some love.
It's a better time to say go Hawks.
Probably the first time anybody's ever been on from Arkansas.
All right. Yeah. Well, it's not a big state population-wise at all. Most of them are there. But so after college, I worked in finance. I worked at an investment bank that looked something like what we're doing here in Palo Alto. So we were helping founders sell their businesses. At the time, it was a lot of internet marketing was kind of in its early days. So, SEO and SEM companies, lead gen companies, which was not a dirty word, but was maybe becoming a little bit of a dirty word. I think it's kind of come back in a good way now. There's some good ones out there.
Yeah. So is this like mid 2000s or
this was like
2010?
2008 or so. So I was on that desk when Lehman went down.
Yeah.
And and the owner of that firm sort of gathered us together, and he's like, the bad news is Lehman went down, and that's going to be a pretty big ripple. The good news is you guys work at this shitty little investment bank out in Palo Alto, not at Lehman. So you guys are in great shape. Life is basically the same.
Now my mind's running with we gotta talk about the contrast between that time and what's happening in markets now. So let's get into that later.
Yeah,
I want to talk about. We're gonna take this conference. It's maybe a fucking 3-hour podcast. I got a hard stop.
We'll just order in some lunch. I did that, which was, again, it's the deals business. It was a lot of fun. It was also a cold calling business. I was same as Jay. I was on a desk calling CEOs. Really good. I think cold calling is really good for anybody earlier in their careers. Just like you said, soft skills is important to have. Super educational if you're lucky enough to get into a spot where you're actually calling that level. Because what a business education. And that's kind of what I thought. Like I come from a family of entrepreneurs on a small scale. We had a gas station in our small town in Bologna, right? But I thought, investment banking, I don't know. I really want to learn about business. I want to learn how businesses work. And that actually turned out to work out really well. I mean, talking to CEOs of real companies all day, the ones that didn't hang up on me. I learned.
Don't let the one ask how old you were.
We had a bunch, right? So it was this, so we had this like boiler room of, young people, early 20s on the phones. And every now and then one of us, not every now and then, frequently, it would get quiet enough where the rest of the group could hear somebody say something completely stupid on the phone, right? And then we'd live with it forever. And my best probably was I'd called a guy and he was chatting with me and he said, I was trying to give him my pitch. He said, hold on. I've pulled up your website here and I'm looking at your picture. How old are you anyway? I guess I was 22. And I said, 25 or so.
Dude, that reminds me, I had this story. So I was at Hillcorp's headquarters and we're in one of their big boardrooms and I'm 24 years old and I'm leading this completions project on one of their wells up in the Marcellus. And we got probably, 15 people around this boardroom table. And we've got the Marcellus field office on video call as well. And when I'm 24, like I don't have a beard, I can't grow facial hair and baby face. I look like I'm 12. And the way that they open up this meeting is one of the executives of Hillcorp. It's like, I want everyone to know that Colin may look like he's a fucking kid, but he knows what he's talking about. So just give him a minute. Like, I know I just turned my beet red. I'm like, man, fuck these guys.
Yeah. So then he climbs out of his high chair to begin the presentation.
But look at you now. You made enough money to get those beard plugs, which look very good, actually.
Which now, let's give a shout out to our sponsor. Yeah. So you, I know that feeling of embarrassment, but it's pretty funny to be like 24 or so, he's counting.
Like in the end, the feeling of embarrassment is also an important part of why you should have that experience, right? It's like, I didn't make up the phrase that like, not being afraid of no is like an incredible superpower.
Yeah.
And whatever you do.
Yeah.
And it's unbelievable. People who are able to internalize that, it's really hard.
And being able to fail too. Being able to fail, like be willing to fail, and it's okay to fail as long as you learn something from that failure and redo it.
So really bringing down the ego to be able to fail, and I think that most successful founders will tell you that failure is to be celebrated, and you got to be able to embrace that. So I didn't really ever think that. Maybe you should be embarrassed in your early years.
Yeah. And it was well earned. Like I definitely should have been embarrassed about that and was.
How did so banking, finance, Mineralsoft.
Yeah.
Closing the gap there. Like how did you guys come up with this idea? Was it something that
how did y'all link up and then how did y'all come up with the idea?
So I spent 3 more years. I switched to the buy side and worked at a private equity fund in Boston, spent 3 more years doing that. And then, that's probably when I sat up and had that realization that I made the comment on earlier, which is like, I've never worked for a real company. I don't even know what it is. I talk to them all day, but I don't really even know what that's like. And so, what I should have done if I'd had the guts was probably just left that job and kind of sat in my room for 6 months or something until I figured out what I wanted to work on. It's not what I did. What I did instead was take out a loan and start business school. So I went to Wharton, not knowing what for my MBA, but like not really knowing why I was there other than to figure out what I wanted to do next, which is, it was still really fun, of course, but business school is super fun for the people who are not going through that, the people who just kind of have it figured out. Like if you were at Bain before and then Bain's paying for business school and you're going back to Bain afterward, that's the setup right there. It's just like a good time. Or I'm kind of over on the side, like thinking about, what do I do? I'm not going to jump into recruiting here and I've paid all this money and I'm not even doing the recruiting. Like what do I been trying to figure out what I want to do? So that summer I was back out in San Francisco and linked back up with a former colleague from my investment banking days. He had become John Parker. Shout out John Parker. He had become a full-time software engineer in the 10 years or whatever since. And he was at a spot where he'd been a part of a couple startups. He was looking to do his own thing. So the timing was right? We're both on that same journey to kind of figure out. And thank God for me, he can actually write code. So I'm like, okay, finally. And that's the running joke in the MBA program, right? It's like you would literally see flyers posted around the undergrad buildings that are like, MBA seeks undergrad who can code, and it was like,
it's like,
okay,
I need a code monkey. Come.
That's right. Yeah, exactly right. And unfortunately for the MBAs, like the market even then had already realized that it was the code monkey who had all the value, right? The MBA was just hoping to get in the middle. So I got lucky to get, and I didn't finish. The only reason John probably agreed to start the company with me is that I didn't finish my MBA. So I left after the first year. Here's where the Arkansas thing comes back in. John hadn't worked in oil and gas. I hadn't worked in oil and gas, but I had, because my, to take it way back, my one of my grandfathers was just this like sort of small time like country trader. He's like land buying and selling. He had the convenience store idea. He was an entrepreneur, but classic like country entrepreneur. He'll buy anything, sell anything, trade anything.
Why do I feel like he was selling pelts? Like
beaver
pelts back in the day.
If you got a good deal on him, he was.
Yeah. There's a ton of stories for him. But closest to pelts is he once like passed a wrecked refrigerated truck on the road that had TV dinners, like Swanson's TV dinners in it. And he paid the guy $20 or whatever to let him load his truck up. And he didn't sell them at a convenience store. Don't worry. Just don't get the wrong idea. He did like sell them on the side and mostly give them away to friends and family. So it was like he was doing you a big favor by giving you a dozen, that would be the thing.
I'm always fascinated. Like there's certain people like that that you come across that are just good at making money in the most oddball ways. I know like two personally that come to the top of my mind that, they're not people that would like go build and scale companies, but they're just good at finding oddball ways to make money.
$100,000 on French bulldogs.
Yeah.
There you go.
Exactly.
There you go.
You just spent $70,000 on this dog? He's like, well, I made $500,000.
That's incredible.
Shout out to JT if he's listening.
It's deal guys, right? Like natural deal guys.
I mean, there's a lot of minerals guys, and I guess that's
that's right.
That's where we're transitioning. But there's a ton of mineral guys where that's how they made their money. Is they're deal guys,
just wheeling and dealing.
That's right,
wheeling and dealing, especially back in the day when it was a little less efficient, the market, and they were finding people who needed money and had minerals, and they were making trades.
Yeah.
So was your grandfather do some mineral deals? Or?
So he did, sort of accidentally, right?
Okay.
I don't know if he ever did a deal that he really knew to be a mineral deal or did it for that reason, but he also was savvy enough to, he probably bought and sold, 1,000 different parcels of land, right? And probably every time he stripped the mineral rights if he could, right?
Yeah.
And so, fast forward now, unfortunately for me,
I love that.
Yeah.
Because like Jake and I bought some old stripper wells up in Oklahoma back in 2018. And the top question that we get from like engineers and the industry is like, how do you do that? I'm like, I don't know. We just went and found a deal and put some money together. And
like I wanted to sell them. We wanted to buy it.
That's it.
But like that, like you hear about your grandfather and you're like, you didn't really even have any underlying knowledge of what he was doing. He just putting pieces together and making it happen.
Yeah.
So I love that. Just like people that just do shit.
Yeah. Yeah, that's right. I have a lot of respect for that too, especially, with with kind of no platform going into it. And that's the other good thing about that kind of work ethic is you don't need a platform. You build a platform just by hustling over time. So he definitely had that. So I ended up with, by this point, things have been passed on and deeded and whatever. So I was getting, this is all Arkansas stuff. This is like Fayetteville Shale. And so I was getting, at this point, sporadic checks, not big money, couple $100, every now and then. And then this like 350-page statement with the royalty check, that was
BP, right? Thank you.
We had BP with BHP. BHP was had Southwestern at that time. Those are the big ones at that time, right? BP too, though. And so look, at some point as we're cycling through, John and I are, it's classic. We're in this room with a whiteboard and we're writing down random, French bulldogs may have been on the list. We're like, what do we do? How do we make money? What do we do?
French bulldog soft.
At some point I'm like, this is a really weird one, right? But there's this thing. I got this check, which is fine. It's not a great check, but I got this statement with it, and this thing's a fucking mess, right? This is like a crazy. I think I'm a smart enough guy. I've actually tried to spend an hour, and because the whole family's getting a little bit of this, a little bit of that. It's not a big difference maker for us, but it's not nothing.
Yeah.
But I'm like, surely someone here knows what's going on, right?
Yeah.
Quickly found out nobody knew what was going on.
Your
I was
thought
probably the
process
first
is
one.
like 2 minutes. Someone can explain.
Totally. I was the first one to ever even look at the statement very carefully, right? It's just rip the check, go to the that's it, right?
Yeah.
And so I thought, well, this seems like a problem, that this is sort of what's supposed to tell me, and my uncle and my cousins, whatever, all the people, they're not industry folks. And this is how they expect to give you the background on why the check was $211.34, right?
Mm-hmm.
This is pretty weird. There's something going on here. And John had worked on, from a software development standpoint, he had done some stuff where they were trying to take, and I think it was in insurance, they were trying to take sort of messy like forms like that. I think it was claims, the insurance claims data, and make sense of it, at a high level, right? Pull out the data, like standardize the data, figure out what's going on, organize it into some consumable format. So he's like, from an engineering standpoint, this challenge it is something I've worked on before. Is there an industry here? And I'll never forget. We made a couple of quick calls. We talked to a guy back in Arkansas who was like a local kind of mineral flipper, and he said, and we didn't know anything. We're just like, what is this industry? How does it work? And he gave us some basics, and he said, it's too bad that you guys just missed it. I think what I would have recommended is there's this conference called NAPE, and it's in Houston. And I think it just happened, but if you could have gone there, then like you would have learned what this was all about. But we looked at the computer, and NAPE was in 3 days, and we're in San Francisco, and we're like, we should try to figure it out, right? I think we should get a ticket and go.
What year was this?
What's that?
What year was this?
This is summer 14.
So
summer 14.
I was at that NAPE.
Yeah,
I was at that NAPE.
Yeah, our eyes were wide. Needless to say.
Well, that was
right?
probably the biggest. That's probably the biggest NAPE.
That was
too.
probably the biggest NAPE I've
in
ever been
attendance.
to.
Yeah.
Yeah.
Every
was
year is
incredible. I remember sort of like a bikini made of cash. And
Yeah.
it was that. Things
Yeah.
were, it was big.
You go to the Pemex booth and you're like, whoa, you don't work in oil and gas.
Mhm.
A little side note, my first name was '08, and I remember seeing all the guys hawking private jets, and I'm looking at the market going like that. Oil's going up, and I was like, this doesn't seem, there's a line to line up to like look about buying a private jet. And I was like, this makes no sense. I flew in from New York, and everyone's panicking back there, and these guys are thinking about buying jets, right?
Wait, so do they have like a jet vendor?
Oh,
at
they had
NAPE
jet
that year?
vendors. Yeah, they had 2 or 3 of them there, and it was a line. You had to line up for 20 minutes to talk to the guy.
Yeah,
It was
times
wild.
we need to get jet vendors.
$47 oil. Are you kidding me?
It was wild.
God.
It was wild. But anyway, I'll short circuit that part of the story. We went to NAPE. We actually went on Vistaprint, and that's when we named the company, because we were like, well, we got to have cards. We got to have business cards like that say something.
So in 3 days, you were just like
We were Mineralsoft.
Mineralsoft,
We were
cards.
Mineralsoft.
Damn, I forgot about
We got these.
Vistaprint.
We got the
Yeah.
like cheapest, whatever. We paid, whatever, a tenth of a cent per
That's what I
card
was
because it
gonna
was the
say,
lowest
yeah.
quality. We probably paid $100 to get them the next day because we had to have them at the event.
It was all in the shipping and expediting.
We stayed at a place, and here's a shout out I'll give here in Houston. We stayed at a place called the Athens Inn and Suites downtown. It is, I don't get in trouble with any of your sponsors here if that's a sponsor. It's by far the worst hotel. And I'm a connoisseur of bad hotels.
First off, we don't give a fuck about
big on it.
sponsors. We
I'm
hurt
big
feelings.
on
So
it. It would be really funny if they were actually, that's where the money went, is to you guys. It was, and I'm a bad hotel guy. I've put more people in the Red Roof Inn, and I love the Red Roof. To me, that's not a bad hotel. This was really bad. Like, I got it the next
So if
morning.
Red Roof is good, I'm scared to see what
I
bad
had
looks
an
like.
early flight out after NAPE, and I got up and I was trying to catch my car to the airport, and the front doors were chained shut from the inside, and I couldn't get out. Chains on the doors.
There was
Heavy.
chains on they wouldn't let you out of your room.
Heavy chain. No, my room was open. I got down to the lobby. My car was waiting outside, and there were just heavy chains locking the front doors from the inside. And I'm like, I don't know what to do. Sort of like a button ring, and the clerk's on, and I have to call or whatever. And finally, I bang on the door, and the guy like wakes up. He's been
like
asleep in the
Quasimodo
office.
comes out with a jingling keys.
Exactly, to get me out of there.
Yeah.
It was crazy. But that was NAPE. So we did NAPE, and we met We met the royalty clearinghouse guys at NABE. We stopped by their booth and met Todd O'Neill, who eventually joined us, worked with us after quite a long path. But we met, we met them from that basically day one, and learned enough to get us excited and think, let's like investigate this a little bit more, work on it a little bit more. And I made the really right. We were sort of in that in between, like that, and that's a question that a lot of people ask, or I'm sure you get that too. Like, how'd you jump off whatever and do the thing? And my answer is that it's like, and this, my wife's okay, I've said this in front of her, but to me, it's a little bit like the question of like, how'd you know to get married? And it's like, I don't know. I mean, you do for sure, and you also don't for sure. There's no calculus that
you
I
just roll the
lined up that
dice.
says,
It depends on what your appetite for risk is.
It's not to understate that, like the magical feeling of love and meeting your spouse, because that's obviously a real thing. But it's a similarly like non-rational. You just kind of do it, right?
I mean, that goes into much deeper topic for another time. But a lot of people, especially in this industry, when they're engineers and geologists, they're very analytical minded, and sometimes that can hurt you if you're too analytical. You get analysis paralysis, and really, talking about, do you just know? I mean, there's a lot of science behind how much faster processing is for decisions on a subconscious level, and it's just like the cliche gut feeling, like, hey, this is worth taking a shot on. So you can't even sit there and articulate like, how did you know? Like, you just did.
Yeah.
So
I think that's right.
What did the actual Mineralsoft software do? Like, what problem were we solving? I know you talked about the complexity of the checks and things like that. So were you kind of working to build software on the behalf of like royalty owners, or was it a marketplace for minerals? Or walk us through that.
It's a good question. Do you want to start? What do you think?
Yeah, I mean, I can start. The first plan we thought was the right market was to go find people like Gabe who had $200 checks, because the other conference we went to was a NARO conference, the National Association of Royalty Owners. And that's a fun one if you haven't been in one of those. Different kind of crowd, more the bingo crowd. But
now I want to go. I want to go to
it. There's a bunch of people who paid $1,000, $100 ticket, and travel expenses, and they have 2,000 royalties a year. They just want to go for a social thing, hang out with other people. But
I drove from Philly to the Biltmore Hotel in my Honda Fit by myself, and it's a long drive and it's a weird drive, like to go to a NARO event at the Biltmore. And of course, I was staying like 5 miles down.
So it was in Asheville?
Outside, right?
Right outside Asheville?
Yeah.
Okay.
With the casino in the basement and the whole deal.
Sounds like a blast.
The next one I met you the next one at State College, and I took a bus from New York City to State College. That's a long ass bus ride. Because flights were like $1,500 round trip, even way in advance. I was like, well, I'm not going to do that. The Greyhound was whatever, $100 round trip.
You got to be committed to take a bus
to the State College from New York City, from Manhattan. That was brutal. But
committed, cheap, or broke.
All of the above. That's what I was at the time. But
the last one, that being broke, makes you pretty committed.
For sure.
But we thought that the original market would be, I don't know if you guys were like a mint.com, like a personal finance that helps you look at all your credit cards and stuff and see where you're doing. We thought the same model would work for minerals, and we were like, well, you talk to NARO and they tell you there's whatever, 10 or 20, whatever the number, 20 million people in America who own royalties. We're like, well, that's a massive market, blah, blah, blah. But we quickly realized like that there's a really long tail. There's a lot of people either just have minerals and don't have royalties. There's no production. That's a big chunk of them. The second one who have it, there's a lot of people making like Gabe. Gabe actually would have been towards the middle. There's a lot of people making $100 a year, like to get one check, right?
That's a great point, because first thing my mind goes to is large total addressable market and aggregate, but how much money is actually in that market when it's small, very fractionalized mineral owners, at $200 checks. So tough crowd, tough business.
Well, you're going to hear how what geniuses we are, because we figured out over a 5-year period what you're about to say in a minute and a half, right? Oh man, this one does feel tough, actually.
But so that's what we thought, and we started building to that. And we kind of, in a little, like we looked into a lot of things, and every successful startup looks into a lot of things. Gabe actually wrote a really good blog post about luck in startups that we have on our website. But we realized that it actually came to us is guys like Royalty Clearinghouse were like, well, the reality is problems are actually very similar, whether you have a portfolio of 20,000 wells or one. Like, you still have the same challenge of you still need to do accounting, you still need land management, you still need to be able to track activity around and so forth. So we quickly said, well, we should pivot. Instead of trying to do a free product or a freemium product or whatever, why don't we pivot and see if there's a B2B business? I think where we really lucked out was we took the product to market. We went live with the product in the market in sort of end of 2015, early 2016. Oil had sort of gone down to whatever it was, $38. So oil was a disaster. But in some ways, people all the mineral buyers have been super busy just buying. So they had no time to figure out how to manage things or even think about software. And plus, software didn't exist. Now prices are low. They're like, well, we're not like, there wasn't, at the very beginning, there wasn't much activity happening for buying. And they're like, now's a good time to start to get organized. And we've actually cut a few people, cut expenses back. So we need to be more efficient on how we manage our portfolios. And software, that's what software does, helps you be more efficient. Where we really lucked out, though, was that obviously we launched a product at the bottom of oil at that time. Later, we found out there's an even further bottom in oil. And then 38, we'd already sold the business. But you can go negative 38.
It was fair to say that, yeah. I mean, very much
and then we ended up coincidentally selling it at December 2018, which is close to the last peak of oil. And in between, not only did oil prices go up, but even more important to us was minerals in the past. It was not institutional money. It was family offices, it was hustlers. But then you had the big private equity shops starting to say, this is an interesting strategy, and billions of dollars started flowing in. And those guys couldn't even imagine starting taking $1 billion and putting it to work and not having software to manage your royalties, your portfolio. So that's where we sort of got lucky, where all of a sudden we thought we were going to sell a product that was a freemium product, and now we're selling it, $10,000 to $100,000 plus a year subscriptions, and that's a whole different business model for scale.
Yeah, I mean, one, I love that you walked us through that arc, because whoever says that luck doesn't play a part in success is bullshitting you, right?
Yeah.
But it's about increasing your surface area and putting yourself in those positions to get lucky, which you guys did. So you can't take away credit. Like, hey, you built something, you had a thesis, and you put yourself in position to get lucky. What's really interesting is 2 acquisitions to Enverus, which come to mind now that I've heard y'all's story and luck. I mean, you can look at Q Engineering, Mark Bahorich over there. I mean,
speaking of $38, negative $38.
They closed their sale a month before oil prices went negative. I mean, you want to talk about getting lucky? I mean, there's always points in the arc where it's like, oh yeah, we got really lucky there. But that's interesting to hear that when Wall Street started, I mean, you had these huge mineral funds, coming in, and that really became a business, was minerals. Whereas maybe prior to that, there were a lot of landmen and people making money, family offices, but maybe not that institutional capital.
Talk about being dumb. What I should have done was Q wanted to recruit me. I was mostly fully vested on my equity, and I should have quit Mineralsoft before we sold it. I would have got the same money either way, and then got a Q and double dipped.
Maybe you put 2 exits to Enverus,
That's right. Well, if you could have double dipped on the acquisition, double dipped on an equity roll, and then double dipped again on the when Enverus got bought.
Jay coming back to Enverus, like, hey guys, it's me again.
That's right.
That's right. That's really funny.
Actually, to your point on luck, I mean, it actually reminds me a little bit, and we'll tell some good product stories, but it reminds me a little bit on where we started on, like, why banking, why are we doing advisory stuff instead of investing or even a startup, on the software side again. And, like, I think another comment I would make is that I am I'm an optimist, but for sure, I'm in technology, I'm in growth, I'm optimistic.
I don't think you can be a founder if you're not an optimist.
I'm optimistic, but
this is never going to work.
But here's a caveat. Like, I'm optimistic, but I'm also pretty risk averse, right? Yeah. And so I think that the VC, and I think a lot of founders are in a they have to be, right, because like it's for survival. So you have to be a little bit of a gambler, and you have to be very optimistic about the future. But you also, I would wake up every day thinking like, what's going to get us? What is the thing, and how do we outmaneuver that? Like, and so I think if you think about the VC world, where it's like it's all about the winners, it's all about the 1000x, and kind of the model dictates that they only really keep the winners in their mind, right? Because they're not going to spend all their time like nurturing the other. It's just the way that model works.
That's really interesting.
And I think we relate much more to the founder who's like, yes, we want the biggest win possible, and you wouldn't be doing this versus a salary job if you were not a risk taker. But you also want a win, and it really matters that you have a good outcome. So that like windows come and go. So it's not it's not a public stock where you can sell it on any given day at any given hour. You have these windows and these moments in time.
Yeah.
And
that's a really good point. So
deal.
Me and Chuck Yates were in Vegas last month, and we land in Vegas. Chuck wants to go hit blackjack, and I'm like, oh yeah, I'll go. And I'm sitting next to him, and I'm not gambling. He's like, you don't gamble? And I was like, no, I don't gamble. He's like, is it more of you don't know how to gamble, or you just don't like gambling? I was like, well, both. I was like, I don't know how to gamble because I never have. I was like, but I'm someone that has an infinite appetite for risk. So I don't think gambling in Vegas is. And I mean, like, it's one thing I go around here saying, I'm like, hedging's for pussies. Like you swing for the fences. And so, but also keeping in mind that there are opportunities for, you want to get on base at some point, especially when you don't have much. And it's like, you want to take a win, but also, I look at people like Elon Musk and Mark Zuckerberg, and you look at Snapchat. Snapchat won. I mean, when they turned down Facebook, I thought they were fucking insane, which probably 99.9% of the world did, and they ended up making the right call on that. So
you look at Instagram too. I mean, $1 billion acquisition. Everybody was like, "Oh, this is crazy," but now Instagram alone's worth like 250, 260 billion.
Yeah, right.
I mean, but it was
a lot of stock.
It was a great outcome. Great outcome for those founders, right? And who would have known that it would have become what it is today?
Yeah,
that's right.
Which Facebook.
You guys I know are probably familiar with this literature as well on like the diminishing returns of there's a very big difference for most founders, most humans, right, between sort of being wherever you are right now and having $50 million of assets. And I mean, you kind of have to ask yourself, like, do you keep flipping the coin? Do you want, is 250 that big a difference? Is $1 billion that big a difference? There's like the real mission, the mission is another side of it, right?
Yeah.
And being mission driven is,
and
I think some of the ones you named are their mission guys, right? As well.
Yeah.
And the money's
talking to successful founders who've had really great exits. Here's what I've realized: anything over 100 million feels the same.
Right.
Well,
I'll take their word for it. But
not there yet. But
I mean, Toby Rice told me one time, he's like, "Look, it's hard to spend $1 million a year. Trust me, I try." And me and Jake were like, "Well, we want to have the ability to try."
That's right. I watched Brewster's Millions several times as a kid, and like he did a pretty good job.
Yeah,
I think. I mean, I'll tell you, like, in our business now, we talk to founders all day, and we're mostly focused on helping them exit their business and sell their business. But obviously, we talk to guys who are also fundraising and sometimes earlier stage. And we don't typically formally advise people or help them raise money at an earlier stage. But the thing is, there's a lot of times where it's, especially in vertical SaaS, it's like a niche market. And you got to understand, like, you might not have $1 billion business, and it might not make sense to raise venture capital and do a Series A, because once you do that, your hands are tied on when you can exit. Like, typically venture funds are going to have a blocker on anything that's less than 3 or 4 times the valuation that they put their money in, and that might push out. First of all, it's definitely almost certainly going to push out your chance for when you can exit, and 2, it makes the bar pretty high. And as you know, I'm sure you've talked to. Never mind in oil and gas. So there's a lot of startups who are just sort of now flat. They can't do anything.
Yes.
They're stuck in zombie zone because they can't raise a Series B and they can't sell.
I had a conversation. I'm not going to say who it is, but I had a conversation this week with that exact situation. The VCs have a blocker. The company, just due to COVID and stuff, kind of took 3 steps back. They were on track to do some really big stuff. Now they can't sell. And so now they're running out of money at the same time. And so you're just like stuck in this purgatory.
You have to differentiate as a founder. This is a great conversation. You have to differentiate between two different types of companies. And I think Gabe said it here, mission driven versus economic outcome. And I think that there's very real opportunities. Like I'm involved in them. I advise them, I help them out, that you can go build something and $30-50 million exit bootstrapped. There's a lot of opportunity for that out there. And that's life-changing money for most people.
And by the way, that the equivalent exit, if you're venture backed, you might have to do a $200 million exit to get the same cash as a founder.
Yes. And a lot of people don't really think through those outcomes and think about that.
And a few additional years of your life.
And also understand, actually, we should talk about this too, because I think a lot of founders don't really understand it. And they should, get smart on this. There's a term sheet book by Brad Fell, I think is probably one of the best on this. But even like how they structure like this, the like pref rights, like they don't understand that, like if there's 20 million in and the sale is only 25, even though they think they only sold whatever quarter of their company, no, that's not how it works. Like they get their 25 first and then the split comes.
Yes.
And and you might not get much at all.
Yeah, if you don't understand the pref stack.
But you'd be shocked. You'd be shocked how few people do.
I mean, we've talked about that book multiple times on this show, Venture Deals by Brad Fields. I mean, I've combed through that book multiple times and really gives you an understanding. And I mean, that's like a digital wildcatters. I mean, we've raised on very favorable terms for us as founders. Because I studied that book and understood where I wanted to be.
And I think, by the way, the other book plug that I think is tied to that for other founders or wannabe founders listening to this would be the Horowitz. That's also just in terms of running your business. I think that's also really good.
I listened to that one
book, I think.
No,
Peter Thiel did, I think.
No, that wasn't Peter Thiel. That was Ben Horowitz.
Oh, that was zero to one.
I said,
yeah.
Also a really good one.
Yeah, but I think it's cool because he goes through these stories of just constantly just getting kicked in the nuts throughout his entrepreneurial career. And you're like, oh, like I'm not the only one.
Speaking of that, super random. But did y'all see that John Arnold's backing this oil and gas credit fund yesterday?
No, I didn't
y'all see that story? Oh, well, anyways, the guy that's running that fund, his name is Richard Punch. Dick Punch.
Dick Punch.
I was like, that's perfect name for someone running an oil and gas credit fund.
I can't predict the future, but the signs were there as retail investors piled in. Really good.
Anyways,
I mean, my last one, since you mentioned Musk, like the last thing on, I certainly I'm not against. I have a massive amount of respect for the $1 billion. I haven't done it. I hope I have it in me someday, right? It's an incredible thing. But Musk is another good example where I'll remind you that he had an exit already, right? And I think our perspective on these, little
it was, I don't know, 30 or 20 or 30 million bucks. It wasn't. And
I
spent $1 million on a McLaren
you look at
F1.
You look at the progression. I mean, a lot of people don't know, but founded Zip2, sold it off. I think that he sold Zip2. It was actually pretty large. I think like $200 million, and then started X.com, which evolved into PayPal. And so you could see his progression. And
somebody read the founder book that just came out. It tells the whole story.
Does it? I need to
Peter Thiel.
Oh, I need to read that. Yeah.
How they got together.
No, actually, a great
PayPal.
book on Elon Musk is it called Elon? Written by Ashley Vance. Great book. But anyways, you saw that progression, and even Elon still to this day says like, "Hey, if you're getting started, like start an internet business and get a win."
Yeah.
So
and I think whether it's an internet business or not, I think the get a win is really
I mean, he didn't go straight to making fucking rockets that can be reused and land. I mean, there was definitely a progression to getting up to that point, right?
That's right.
So, you guys, obviously, you built out Mineralsoft. Things in the market had changed on a macro level that played in your favor. Enverus comes in as well, which is also kind of an interesting part of the story because around that time, Enverus had been, I can't remember who the PE fund was. was it Genstar?
Genstar was the
Genstar,
first one.
yeah.
Yeah, that was there when we bought, but
Insight was in there for
Insight was the very first
Okay.
one. That was I think 10 years before,
Yeah,
8 years before.
But Enverus
Genstar.
is really, the point being, Enverus was really starting to ramp up and wanted to kind of be the kingpin in the industry, and so they were setting up for acquisitions. Which,
yeah, that's right. And Genstar, that's their model, is they do a lot of inorganic growth with their companies. That's why they did so many deals and being a home run for those guys. But I think we'll talk, if you want, we can tell you a little bit about how we got there. Because we actually started what we called Drillinginfo at the time.
which
We actually,
still be
I don't know,
such a good name. Like
A lot of
everyone loves DI. Yeah.
As a quick aside, after the acquisition, I said we got acquired while they were still Drillinginfo, but they were shortly about to announce the name change. And I was in, like, they brought me into this like executive meeting, and it was with the branding people and everybody. And it was a room full of people, and they had obviously been living and breathing this name change, super painful process for like a year. And the CEO was like, they were about to start talking about it. And he said, no, wait. Oh, Gabe's here. He's new. Okay, hold on. Okay, Gabe, Enverus. Like, what do you think? Because I was the only fresh, person in the room, and everybody's looking at me, and it's clearly like they've spent a ton of money, ton of time, like massive brain damage trying to get this done. And I'm like, I like it. I think it's really,
great, guys.
It's really good.
Once my check hit the account,
I would make sure that people know how to pronounce it, because it could be like an Enverus, but maybe that's just me.
Yeah,
it wasn't just me. It turns out.
Yeah.
But.
I mean, a big pivotal moment for our business.
Before you get in, like what I want you to kind of get to in this is like talking about how y'all said, like, how did the acquisition actually happen? Because I know that's actually what y'all are doing today at ScaleView, is part of the advisory, like helping to make those acquisitions happen. So dive into that.
That's a
when you get a chance.
perfect actually path into that. So I'll have to look back exactly when we did it, but probably a year and a half or so before we sold the company, maybe even more, I don't know. But one area we were really struggling with that we thought was really important. So there's sort of three major components to our product, and one was the accounting component. Second was land management, and then the third part was tracking activity around your properties. Because if you get those three overlaid, and historically they weren't. Historically, you had a land management system, probably Microsoft Excel. You had some accounting system, and then you had Drillinginfo, but none of those things talk, so you couldn't get any real-time insights to help you. So we had sort of tackled the accounting part. We had tackled the land part, and we were to build those ourselves. The thing that was a real struggle for us was the activity thing. We had tried some other startups at the time. I think now it's probably changed a little in the last few years. I think there are, that's a little less challenging. But we had tried it a couple of vendors. It was a disaster. We just couldn't get like reliable data to overlay. And we had a friend who worked at Drillinginfo, and he was sort of on the strategy side. And we talked to him. We said, maybe we should try to do a partnership with them, because their data is super reliable, and they spent a fortune cleaning it up, and what have you. Number two, frankly, it's a lot of validation to have Drillinginfo as your partner. We gave up pretty significant economics on that partnership. And, I don't know, it worked out in the end, but who knows if it would have worked out long term on the kind of economics we gave them.
Yeah, we did a revenue, to be clear, we did a revenue share.
share.
We didn't do an equity partnership, but we did a revenue share with them on the sort of joint product.
And
it was interesting because it was, like Jay said, it was a little bit painful for us as a little company without a lot of revenue, and it didn't make any difference to them. It's a tiny, so I guess we'll take your check.
That always, it's a really
true.
interesting dynamic, because especially when you're a small company, you're like, it could be nice if we got paid for this.
That's right.
Like you're thinking about bottom line and being able to pay bills. So definitely feel that.
So then then going forward a little bit, and how like the acquisitions, or how we got to there. So the other key piece for our platform, the accounting side, was to bring in accounting data. And there was three major players in the sort of accounting data market when we first started. One was a company out of Austin called PDS, Barry Barksdale. And there was OilDex, and then there was EnergyLink. And we had some crafty things in the very beginning to sort of end around them, and that's a whole other set of stories that talk about startup, pains.
Yeah, we'll come back. We'll come back to it.
We'll come back. That's a good one. But so what happened is early on, PDS sold to Oildex. Or not early on, actually. I guess whatever. A little bit into our business, they sold. We're like, okay, now we're down to 2. We ended up doing a partnership with Oildex as well, to get data from them and have it fully integrated, and clients don't have to pay separate bills and manually load in. And that was super powerful. And then fast forward, and we're about to go, Gabe and I are about to go as a mini sponsor to Oildex's annual user conference. And it was in Colorado. Anyway, we go out there. The day before we're supposed to go out there, the CEO of Oildex calls us and says,
was it Peter Flanagan?
Craig Charlton.
Craig Charlton.
Okay.
He was the Excel KKR guy.
Okay.
They brought him in.
All right.
So, and he's like, I got some news for you because I know you have this partnership with Drillinginfo. I don't know if you know yet. We're going to announce it tomorrow, but we just sold the business to Drillinginfo. And we're like, well, obviously, we're like, congratulations to him. And by the way, from what we heard, it was a home run for the Oildex investor. I think it was, multiple and it was smart for Drillinginfo because it was a very strategic acquisition.
Looking back, it was a home run for
both sides, but they were extremely happy about their exit, and in the end, it's been a heck of a business for Enverus. But so we're like, well, this is kind of scary because 2 of our partners are now merged. There's a chance that they could just cut us out and develop. They're a software company. They could build their own mineral management software.
Yeah.
So we quickly pivoted. We flew out there to, I guess it was Park City. I don't know, but we flew out there.
That's right.
And we changed our. We were just supposed to be out there manning a booth, and be a nice sponsor. And next thing you know, we're having sort of early back channel communications about this maybe makes sense because we are the glue that sort of brings these 2 products together today.
Yeah.
And maybe it makes sense. And
so you start put that seed in there.
That's right. And we had some conversations in the past about whether, they had sort of, around the edges said, maybe we should buy you and what have you. And we sort of politely declined. And but this time it was like, we had to finesse it because you can't look like you want to sell. And we knew they were the natural buyer for us.
Can't look desperate.
And that was probably end of August, thinking back, maybe early September. It was around that time. And then, we went through and we closed that deal in mid-December. So 3 or 4 months from start to finish. And it was, I would hesitate to wonder what it would have looked like if we'd continued beyond 2018. Our biggest competitor just sold, just announced the sale. Our biggest competitor back then.
Which was a weird acquisition.
Yeah.
Mineralware, right?
Mm-hmm.
Yeah. The economics on that, we'll have to get the Mineralware guys.
You have to get them. I
thought essentially they sold it at 3.2x on revenue, which is just odd given the tailwinds and energy right now.
It is, but I still think it's look. If anyone can get an exit, and they got an exit in all cash.
Oh, that's what
that's what I'll say. Like
all cash, you put a premium on.
There's a lot of companies who didn't take offers and are zeros.
Yeah,
and I think they actually
back to our point of getting on base.
The limited stuff I know of, the limited stuff I know of where their business went in the 3.5 years between when we sold ours and theirs. It's a tough, really tough market for oil.
Yeah.
Growth
You're
is,
talking about that 3 years. That was a fucking grind.
Yeah. I would guess growth was a challenge because I know from Mineralsoft, growth, it became a challenge in some of that time.
But which is also really, which is a good talking point too, is that, multiple exits in a very niche space, in the same space. So that's actually pretty interesting too, is that you had multiple exits.
It's the Mineralware deal, and I'm super happy for them. They were a good competitor, very honest.
Love that team over there.
Who do they sell to again?
SS&C.
Yeah, SS&C had bought. They're a financial technology company. They had bought a couple years back Innovest, we made a product called PDS, not the PDS we just talked about.
Yeah.
Very confusing. Oil and gas. It's also confusing. But what's worth making more confusing. It's also in accounting, but it's accounting software versus accounting data. But there was 2 PDSs, and that was part of. They rolled it in, I think, to sort of grow that business.
But I those guys, they've spun up other businesses that they're still working on and maintaining.
Yeah.
I think they had a really more than respectable exit on the thing. And if you look back to that NAPE that John and I went to in 2014, sort of the big name, well-funded tech companies in and around the space, then there have been some not so good outcomes.
Yeah,
and
for
so
sure.
I think that's
for sure.
That's very good on them.
Yeah.
For us, I think we kind of sold the business to Drillinginfo twice, right? The partnership was the first, chance to, and it is a common, sort of date before you marry. How do we get involved with each other and get a look at how complementary or not the businesses might be? There's some risk to it as well. And when you're the little, you guys understand this. When you're the little guy and you're going to try to, I think dancing with elephants, they would call it, right? It's risky, right? A lot can go bad. I as an aside, just on all of this stuff, I have a lot of respect for Enverus. It's a well-run company. In all our dealings with them, they were honest. They did what they said they were going to do, and that you can't count on them, right? That's why it's high risk to be a little guy. So you're like, well, they said this, but what if? And that's the scary stuff. They always did what they said, right? So that's the main thing.
Which is
I'm
extremely
curious
important.
Those like 4 months of kind of like negotiations. Was it them kind of driving the outcome, whether it be just through whatever it may be, or was it you guys kind of pushing more so to say like, hey, this is kind of what we're looking for? And
it's a so that was that was me playing banker, right? So that's the most direct like prelude to thinking, I think this is what I want to go back to doing again full time, right? ScaleView.
This is where my experience really comes into play.
That's right. It's good. And so take that 1 year of MBA and go to town. But dangerous level of knowledge. It was the interest was there, and the fact that we had the partnership in the background meant that we had a level of comfort on both sides that was really helpful. We both had also a framework, I think, for like, what is the value here? Why does this even make sense? Like we had actually data to support that, right? We said, well, here's what we've done in the product. Here's like, so that was really helpful context. And then what does it take to get it done? One of the interesting things about this part of the market generally, this part just being like the small end, frankly, the lower middle market type of deal, is that it is less a financial engineering exercise to say, well, our weighted cost of capital is this because we have this debt facility, and then we're going to. That may be a conversation on their end, deep in the background of like, how do we write this check in an efficient way? But that's never the conversation with the target. The target and the real conversation for us is like, what's it going to take to get this done, right? And our signal, which we believed, even though we had some fears, and which you always do when you're a startup, our position was like, look. We just raised an A round 11 months ago. We raised an A with Montrose Lane, Cottonwood Venture, another name change on us, but Cottonwood at the time, Montrose Lane, love those guys. And so we had the balance sheet and the momentum and everything else to keep going. And that was our position, was like, look, our default here is that we're heads down running the business. We just added more capital. Like, we've got a lot of runway. That's what we're going to do, unless there's a sort of take it today price. And having the investor involved also gave us a real, not negotiating tactic, but a real sort of level, like it gave us a real hurdle to clear, to say, well, look, these guys contractually don't have to say yes to a deal unless we get above a certain threshold. And if we're talking about deals below that, then they literally have approval. Right?
It's funny. I said earlier, and I said that's the reason that you have to be careful about taking in venture. The plus side is, if you do have a process, you can point to a number and peg a number to say, well, we contractually can't sell for less than this. Now, the reality is, you probably can. Not contractual realities, you'll get them. Sell below that, but at least you can point to a number that's like way up there. It's a starting point.
So did you guys have that from raising the Series A?
We did, yeah.
Okay.
Yeah, we did. And
how much was your Series A?
Big.
$4 million?
Yeah, $4 million.
I think.
Smaller than most seed rounds. in
Yeah,
today's
these
day and
days.
age.
Like you said, when we sold the company, I think we had cash in the balance sheet equal to all the money we'd raised in the entire life of the company.
Nice.
Yeah.
We had $5 or $6 million
We
in
were
cash on the balance sheet when we
Yeah.
sold it.
we
So
were
that's
pretty capital
also-
efficient. We raised
yeah.
I think we raised 5 or so in the whole life of the company, about
Yeah.
$5 million. And
Yeah.
as Jay said, we sold it with most of the money in the bank in the end. But that was the process, and then the back and forth issues on the economics are all cash versus stock, right? Which plug the blog post again. We've written about that. So
The
it's a big
founders have
one,
on
right?
Yeah,
Scale.
we'll I want to link those blog posts
Yeah,
in,
cool.
in the show
Yeah.
notes. That way people can go read those. I haven't seen them, so
Yeah.
I'd like to read them myself. So we'll put a link to those for sure.
Cash and stock is a big one, and we just at a high level, we started with kind of a mix of cash and stock as the opening offer, and we to more of an all cash structure with him,
Mm-hmm.
which made the investors happy. The investors want cash.
Yeah.
That's their business, right? And so so we moved to that structure, with the exception of a couple of the co-founders. They insisted that we roll a certain amount of stock, and by looking back, I wish they'd insisted we rolled more. It's been a great company, right? And so that's hindsight. And then a lot of the management, to be honest, a lot of this sort of, here's the deal, you get really, and this is something we talk to other founders about all the time, about the deal process itself. It's very hard to sort of put the thought in your mind about what's it gonna be like when we sell this thing and the wire hits the bank and the shares are transferred and this isn't my job anymore. There's good and bad that comes with that, and there's a lot of like wrestling with it that you have to deal with.
Yeah, you hear a lot of founders deal with depression after
Yeah.
acquisitions, which is, it's kind of this dichotomy, right? Because okay,
Mhm.
you had a great economic outcome, you built something great, were able to sell it, but then all of a sudden you lose a kind of big part of your identity, right?
Yeah, there is, and there's a I'm big. There's this like hedonic treadmill concept. Justin Kahn, we did Y Combinator with Mineralsoft, and some of those guys. Justin Kahn was one of the Twitch founders.
Yeah.
And he's done some other stuff.
Yeah.
He talks about that a lot, right? I think he's a big one. He's like,
Yeah, I think he opened up about that a lot over
Yeah.
the past year, and wrote some good material on it. Just talking about, I can't remember what the outcome was for Twitch, but I mean, $1 billion, unicorn, and then
Yep.
felt that pressure that he's like, I got to go do another unicorn, and just dealt with a lot of mental hurdles that came
Yep.
along with it. So
I think maybe one of the things that helped, by the way, we weren't sort of contractually obligated to stay at the company after we sold it, and in fact, John left almost immediately after, our CTO. And
Yeah.
Gabe and I stayed on, and part of our reasoning for staying on was to help our team make sure they got sort of integrated well and took care of them and so forth.
which
But it also
says a lot,
helped because
too.
we had something to do for a while.
Something to keep you busy, yeah.
And then it really helped
Right.
when COVID
Yeah.
rolled around. Like, well, maybe we ended up being there for almost 2.5 years.
Yeah.
And the original plan was maybe a year.
yeah,
And then COVID rolled around. Well, we're definitely going to stay now for a little bit more.
for sure. Yeah,
But
that's
that really helped, like mentally, I think, too.
Yeah, that's also an interesting dynamic too. Kind of post acquisition. Different companies have different situations with earnouts, and
Yeah.
how long you need to stay on, is it critical? But that actually says a lot about you guys, that you wanted to stay on. You care about the team to make sure that it was a smooth transition to the team, because you got to think about the emotions and volatility
Yep.
that they go through.
Yep.
As well. It's a lot of change for them too. So
I think the other thing, too, that we did, I think that was important for a lot of the team, most of the team had equity, but a lot of our growth and headcount had been, within the last year, we probably doubled. Every year we were at least doubling revenue and definitely doubling headcount. There was a lot of people who hadn't even, normally it's a 1-year cliff on vesting. So we had a lot of employees who hadn't even invested, and the founders came in and we agreed to let everyone actually vest
that's awesome.
1 year to
Yeah.
make sure everyone got something out of
Yeah.
it.
Yeah.
And I felt like I had a win.
Yeah.
I think that's important too.
It is very
As a
important.
win.
That's what I tell a lot of our team members. Is like, a lot of founders, I'm not going to say a lot, but there's definitely cases of founders that don't give a shit about economic outcomes for their team members. They take advantage of the lack of knowledge around restricted stock units and stock options and how they work. And they don't put a lot of time into structuring things to make sure that their team members have a good economic
even the ones who
outcome.
didn't, we even gave at least a small cash bonus as well.
That's what I
think Alan Gilmer did that, but I don't think many people had stock options coming. I think he famously went to the bar with a duffel bag of cash. Started into that,
which is a very Alan Gilmer.
That does not surprise me one bit.
That's awesome.
Alan's one of our biggest investors, and I was like,
is that how he sent the funds to?
No. Let me tell you. We go to raise we raised a seed through angel investors, and I send Alan a message on Twitter. I'm like, hey, Alan, we're gonna raise some capital. I would love to have a conversation with you. He's like, hell yeah, send the deck. I send the deck. I didn't hear anything from him from like 3 weeks. I'm like, hey man, just following up. Wanted to see if you want to get on the phone and talk. And he's like, mark me down for this amount. Send me docs.
That's awesome.
Oh yeah, cool. Wish
Two
all capital
DMs.
raising was like this.
I'm a big fan of Alan.
And like Alan's thing is like, Alan very much just wants to be involved with cool things and wants to help the next
he's awesome.
Help the next generation up. Like, I have not heard one person have a bad thing to say.
Like, you cannot
Alan
spend
Gilmer,
5 minutes with Alan and not be like, man, this is a good guy.
That's right.
I just love that he's always got like these funny stories that he tells, like, especially when you get him and Chuck Yates together and they just go and like full on old man telling these old stories back and forth. It's awesome.
I've got a friend, this is crazy, but I got a friend from college. I went to Yale for undergrad, and I've got this friend from college, and she grew up in Berkeley and went to Yale and like did like her like master's or doctorate at MIT. She's like this tech neuro crazy character, super interesting.
Yeah.
But if I were to put people in just on the globe on a spectrum, I would have thought that it was like Coco at one end and Alan at the other. And I never would have even thought of the two of them in the same day. And at some point I got a text from her, and this is in the last year or two. She's like, do you know Alan Gilmer? No, I do. Why? And she's like, well, I'm drinking margaritas with him on Cinco de Mayo. And I was like, how in the world? And that's her thing. She's writing some kind of book. I'll have to catch up with both of them and find out what they do. But she's like writing this book, and somebody said, you got to meet Alan. And she did. And they just hit it off because that's Alan, like anybody would, right?
Yeah.
With Alan and like,
Can find common ground with anyone.
That's right.
Yeah, for sure.
I think the only person who's like Alan's a suit tailor. There's much business there.
That's why me and Alan get along.
that's right.
We very much have common ground from our backgrounds in oil field and coming up
I
in
think
the
he
tech
probably
industry.
frustrates
So
private jet guys too. We bumped into Alan many a time before they bought us on Southwest.
Yeah.
And like he's had obviously immense success, and he was Southwest. He had business select, so you got a good seat as far as Southwest seats go. And we were definitely not business
exit
select.
row.
He was A1.
I will say that.
So man, I know on this podcast we could probably talk for 3 hours, but our listeners aren't sitting here suffering with us. Our air conditioning is not working back in the podcast studio, so I'm sitting here fucking sweating bullets. So let's save stories for. I think that we're gonna have a part 2 on this podcast now that I have some context into y'all's backgrounds and how y'all are advising startups in the M&A process now. I think that there's probably a whole other episode that we can do walking through that process.
Yeah.
Alone.
Yeah,
in itself.
I think so. I mean, one, the last comment I was going to make about kind of our deal in that 4 months, what happened, between the
go into
and
that.
the actual
Finish that up.
The biggest thing that happened, I mean, to me, the most kind of consequential thing that happens is you get it in your head as a founder for the first time. You actually let yourself think about selling the company, right? And you think about all the good things. You think about like, what's my life going to be like? Like you think mostly about the good things. There are some bad things, as you pointed out, but I'm going to have security for my family. This is going to be great. I can pick a project, next. All this stuff is going to be positive. But then you live in this limbo where you've let the idea into your head, but the deal is not yet done, right? And that is like super scary place to be. It's a dangerous place to be because you have mentally committed to this outcome. And if something does go wrong, there's a real question. Am I going to be able to put myself back in that like grinder mode? Am I going to be able to put that back down and go back and do, you know, startup life like I've done before? And so it's a really tough thing. There's a lot of risk there. I'll be really complimentary again about Enverus. They did what they said they were going to do. There's attorneys on both sides and they are what they are. So you're always kind of whipping them and trying to tell them not to pick fights over stuff that doesn't matter. And you're super focused on a deadline. And we were targeting close right before Christmas, right? And so we're like, this cannot slip at all. If it's Christmas, then the attorneys aren't going to fucking work over Christmas. And then it's going to be New Year's. Then there's some tax thing. If it rolls into the new year, it's going to be a pain in the ass to have to redo stuff. And time kills deals. You're right. So we were just pushing super, super hard to get it closed on the day we picked. And we did. But I think, they don't always work that way. And a big part of what we do now at ScaleView is run that process, manage that process, provide more certainty that the things are going to happen on time and as promised, and be there for the founder, right? Through that very fraught. It's a really hard, it's strangely enough, it's one of the toughest parts of the process, in my opinion, even tougher than the ups and downs of startup life. Like if you're in it for any time and you're any good at it, you know how to like put on your blinders and you're like, I'm startup mode. This is what I do. I grind. We're going to grind through it. You know how that goes. But once you've let that exit into your head, it's a really tough time. It's a really tough time. And so
I learned that at my last startup. Like I always say that spent too much time in the calculator and thinking about economic outcomes, and it puts you in a bad headspace.
Really bad.
Yeah.
You got that Excel spreadsheet with the waterfall, and you're just imagining what, and that's the good and the bad. It is, kind of a life-changing thing you're contemplating.
Yeah.
And not everyone is. I mean, I guess my last comment on that is, maybe people don't. I'd still like to plug ScaleView and say, even in our process, we would have greatly benefited from somebody like us who was an outside party with all their attention just on the process. And it's hard to be the good cop and the bad cop as the founder when you're selling the company and you want to negotiate hard, but say, also, I'm so excited about this combination. It's going to be great. We'll work together for the next 20 years. A banker's really good for that.
Yeah.
But the real issue is that it doesn't always go as smoothly as ours did looking back. And the buyer doesn't always do exactly what they said they were going to do and do it on time.
Yeah.
And, they know very well what's going on in your head once you've let that deal idea in, and they know how that shifts leverage.
And they're gonna play into that. Yeah,
that's right. And people will absolutely use that as a tactic against you if they can.
They've given you a bit of a taste. I mean, you see Elon Musk doing this to a certain degree with Twitter right now.
That's right.
So
look, last thing I'll say,
he holds all the cards.
Yeah. I'll do one last quick plug. I think Gabe made it earlier, and there's a lot of oil and gas people obviously listening to this, and oil and gas startups. Enverus, great company, great acquirer. We hear a lot of people poo-poo them, just as, their software is no good. I mean, that's a joke. The company is, a hyper successful, one of the most successful, never mind oil and gas, one of the most successful private SaaS companies in the world.
Yeah.
And their acquisition process is world-class. And the way they treat the people after you join it, I couldn't say anything better about them.
In closing, I have one question, and we can just keep the answers short. I'm just kind of curious, and I'm sure listeners are as well. Because I think it also kind of ties to doing a part two, more focused on ScaleView. In your personal lives, after the exit, money's in the like you're closed out, everything's good. What would be the biggest change that you saw in your personal lives, if there was one? Could be stress is gone. It could be like
you would think it might.
I bought a motorcycle. I took a 3-month.
Bought and sold all the toys already. It went full circle on a lot of the toys.
Yeah, I did kind of do that. I might have sold the top on used cars. We'll see how it goes. My bigger thing, and look, my disclaimer on this is that I had a bunch of, it's like going on a diet and stopping smoking and stopping drinking all at the same time. And you're like, maybe which one of those was good? I had my first child. He's 18 months old now. We're expecting another one any day day now.
Congrats.
Thank you. So my life has changed, right?
Yeah.
And so there's a lot going on, but perspective for me is different. And it is a combination of those things, but it's been a reason for me to sort of step back and think about why I played that game to begin with, in the context of a win, right? In the context of it going incredibly well. It's kind of made me think before we started ScaleView, it's made me think like, why did I play that game to start out with? Where does it fit into my into the bigger picture for me? And it, by the way, it does fit. I mean, that's hence ScaleView here. I'm not sort of gonna sit around and just hang out with my family. We get tired of that version of me. But I think being a little bit more thoughtful about not just, and on that level, I think I was pretty thoughtful about like the tactics and what are we going to go build and why and how are we going to sell it and all that tactical stuff. But I think really for the first time now, after like the working in finance and starting Mineralsoft and selling it, I finally kind of asked the question of like, what's the game I'm playing and why at all?
Like,
That's
where do you
actually,
spend time?
From my point of view, we have two different types of founders sitting across the table right now. Had economic outcome and an exit, and ones that haven't. So that means is y'all have money, we don't.
As far as money, we have none.
But it's like sometimes I actually get scared of positive economic outcomes because I personally enjoy the journey and the grind so much that I'm like, I don't ever want to fucking lose it. Like I like the hard times because you talk about you put on the blinders, you're like, we're gonna fucking grind our.
You think it's gonna make you complacent?
I'll never personally be complacent, but I just like get like I know that I'll look back 10 years from now and I'll miss the times that were hard.
Mm-hmm.
I know that. And
I mean, I already look back now to 5 years ago and I think some of the really hard times and I'm like, damn, we had some good times.
It's pretty
I mean,
cool.
we'll make a deal with you. We'll help you sell your business, and then we'll make you investment bankers. You come and join us, and you can learn that
We're
craft.
in a deal in here on the podcast.
We need more founders.
Before we end the show, though, I want just real quick. Let's talk about who are the target startups or founders for ScaleView. I mean, is there a bucket that you guys have defined in terms of stage or valuation? Who's the ideal startup if they're listening to this show that should be talking to you guys?
Yeah, I'll take a stab at it. We say founder-led companies. That's important to us. It's just I think it's more of just there are a lot of different flavors of advisors and banks in the market. That's who I think should pick us. Because we get it. We've been there.
Yeah.
And so I think that's sort of the right client for us. Software companies in general, but technology companies broadly. We're working on some stuff that has a hardware component now. Technology-enabled services. There are a lot of those models that they look and feel like software companies, at least on the financial side, which is really exciting. Scale-wise, I sort of $5 to $15 or $20 million in recurring revenue is a pretty good sweet spot, I think, for us and for the market.
Yeah.
Just to be able to look at a significant transaction, and that's really the last thing I would say is it's mostly folks who are now. This isn't necessarily when we want to meet and get to know you. We'd like to get to know you now, right? Whether you're thinking about that or not. But what will you actually end up paying us to do someday? Maybe. It would be work on what I would call a significant transaction. You're going to sell the company to a strategic or a financial buyer, or you're going to sell, a significant portion of your shares and roll some forward. But it's kind of a real money thing. You know, most people don't need to pay advisors to raise an A round. They don't want to hear from an advisor usually on an A round anyway.
Yeah, so it's kind of crazy to me. Small. Like I talked to a startup the other day that used an investment bank for an A round. I was like, why?
Yeah, I mean, an A round also used to not be $100 million or
right,
whatever.
That's the change. I would say 20 million transaction size is sort of the floor. Where even if it was an A round, I mean, that'd still be weird. But I think if you look at it from that perspective, either revenue or overall transaction size, 20 million.
Sense. Do you guys, is it only, are y'all only working on acquisitions or do y'all help on capital raises as well?
Yeah, we certainly help on capital as well. I said secondary, that doesn't have to be the case. But,
that's what I was asking, if it was only secondary.
It doesn't have to be. That kind of goes back to your comment on the A round. If somebody's going to raise a significant round and it really like is worth the investment to optimize the process. And if you're going to raise 20 or 50 million bucks, it probably is. Like that's a big deal.
Yeah.
But what's typical for us, and traditionally in those, $50 million rounds, call it, you'll see a portion go out the door for founders for secondary, and then a portion to capitalize the business. And that's kind of a classic growth equity one where there are a lot of players out there, a lot of capital providers there. And so it makes a ton of sense to have a banker help you run a process to look at a lot of options.
Yeah, understood. Well, guys, this
is probably
one of my favorite shows.
Yeah, one of my favorite episodes. People ask me all the time.
Yeah.
It's like picking your favorite children, but since we're sitting here right now, this is...
Yeah, I can already tell, like, this is one of our best podcasts that we've done over our coming up on 4 years doing the podcast.
It's the best one that Jay and I have ever done.
Yeah, well,
the only one
you're no longer
by default.
No longer podcast version.
When you eventually sell this one day, we'll flip the tables winner to you guys on your story, on your podcast.
We'll do it. Absolutely. So, guys, appreciate y'all coming down from Austin and taking the time to do this. I know this is going to be extremely valuable for people that are listening. Guys, if you're a startup founder, aspiring founder, listening to the show, reach out to these guys and start building a relationship. I mean, you don't want to start building it when it's time to start doing deals. You want to start building relationships early in the process. I'm sure these guys would appreciate talking to you and just have a ton of insight to offer. I mean,
and they're founders. They're founders.
That's
what I love about it.
So, guys, thanks for coming on the show.
We appreciate it.
Thanks for having us.
Let's go to a cooler room.